So it was just announced that student loan collections are going to start again. Who does this impact and what does that even mean? For the million of borrowers that have been in repayment and making payments as they're supposed to, or they're in the save plan forbearance, you're fine. There's nothing happening to your loan. Collections starting on student loans directly affects those who have defaulted on their federal student loans. Default means essentially that you did not make a payment, a required payment, for over 9 months. And in some cases, depending on the type of loan you have, even up to a year. Many people who are in default know that they're in default or understand that they're in default. The confusion comes to those who aren't sure what status their loan is in. So missing the payments all has to do with the fact that you were required to make payments and you didn't. For those with a defaulted loan, you might not have experienced collections on your loans for over 5 years because there was pandemic relief. Now that is ending. Collections on a federal student loan essentially means that now different tools are being used to collect on that debt. One of the tools is administrative wage garnishment. They can garnish your paychecks, Social Security payments, and those types of things. In addition to that, they've indicated that they're going to start the Treasury offset program. Your tax refunds could be sent as a payment on your loan. These types of collection activities are known as involuntary payments. The Trump administration has now decided that any type of relief offered is all going to expire, and anyone who has a defaulted loan, the collections will resume. This is not a new policy. This is not a new way to treat federal student loans. This is how federal student loans are actually treated without any relief provided. And it's not common for relief to be provided. Relief was provided throughout the pandemic and through the Biden administration. So now we're just looking at these loans returning to the status that they were in before all of this happened. Many of the borrowers affected by this were in default before the pandemic, and you've had a break for several years. During the Biden administration, if you were a defaulted borrower, you did have the option to do what's known as fresh start, which only required a request to have your loan removed out of default in order for that loan to go back to good standing and for you to have options to repay your loan under the income-driven repayment plans or other types of repayment plans out there. You actually got all your borrower benefits back for the federal student loan, because with a federal student loan, you lose those borrower benefits as soon as that loan is in default. And then you need to resolve that default to get them back. Thankfully, in the federal student loan system, there are some ways to get your loans out of default. There's student loan rehabilitation, which requires 9 voluntary consecutive on-time payments. The payments are based on a reasonable amount. If you were already in collections when you start rehabilitation or rehab on those loans, collections may continue up until the point where you've made 5 payments. Another option to get your loan out of default is through direct loan consolidation. This works in a few different ways. You either have the option to consolidate your loan if you're eligible, and then agree to repay under an income-driven repayment plan. If you do not want to pay under an income-driven repayment plan, or there's another reason why maybe you don't qualify for one or it doesn't make sense under one, you do have the option to make 3 on-time voluntary payments prior to consolidating in order to become eligible. For both rehab and consolidation, you need to make sure you're eligible to complete either option. And if you're eligible for both, people wonder why rehab or why consolidation? If consolidation is so fast, why don't I just go ahead and consolidate? Well, rehabilitation does have its benefits. It allows you to remove the record of default once you could successfully complete rehabilitation from your credit report. And that can help you in a lot of ways. Now, the delinquencies on your loan aren't removed, it's just that record of default that's removed. But that can be helpful for a lot of people who are looking for ways to quickly increase their credit score or help them with additional purchases or additional uses of credit, like a mortgage or buying a car, those types of things. Consolidation will not remove that record of credit from your credit report, but it will get you out of default faster. Now, some people choose that option because maybe they're not eligible to rehabilitate, so they decide consolidation, or maybe they're trying to go back to school and you actually don't qualify for additional federal student aid if you have a student loan in default. So if you need to make a quick change or a quick fix, that's a way to do it with consolidation. Like I said, both are gonna have requirements and eligibility requirements. So you may not have the option of rehabilitation and or consolidation. You're gonna have to talk to what's known as the default resolution group. And that is a group that's part of the U.S. Department of Education, Office of Federal Student Aid, and you can find some of that information right on studentaid.gov. Being in default is a tough place to be. There's a lot of consequences for being in default. By the time you get to default, you might have already done significant damage to not only your credit, you might also be reported to an agency called CAVERS, and CAVERS is where people who have defaulted on federal debts are reported, and it might prevent you from additional federal loans like FHA loans to buy a house and things like that. Other issues with being in default is you will be charged collection costs on top of your interest. Collection costs can be up to 25% of the loan. Essentially, they're saying it costs up to 25 cents on the dollar to collect and pay for collections on your loan. It's an additional cost to collect that on top of the interest on that loan. The impacts of all this. Based on the statement from the U.S. Department of Education, there are more than 5 million borrowers who have defaulted on their federal student loans. There's an additional 4 million borrowers in a status known as late stage delinquency, meaning they've missed their payment by 91 to 180 days. You have to get to 270 days under the direct loan program to hit default. So even those in late stage delinquency, I urge you to take the time to find a repayment plan that works for you and find a way to get caught up on those student loans. Borrowers who have defaulted on their federal student loans, you've had a break for several years now. You might already be living in a challenging situation, living paycheck to paycheck, just trying to cover the basic needs, housing, food, gas, transportation, those types of things. The issue with collections starting again is if you are earning income, you could be subject to administrative wage garnishment. So if you're living paycheck to paycheck, that paycheck could get smaller. So it's best to contact the default resolution group to discuss your options and find a way to get yourself out of this situation as quickly as possible. After 5 years of relief, May 5th, those collection activities started again. It's not an easy time right now to take on this additional debt, but it should be a priority. You should work through the best way to get yourself back into good standing. Once that loan is back in good standing, you could look at things like income-driven repayment plans or other ways to pay off the debt and not have it impact your financial situation as much. I will say the calculation for administrative wage garnishment, even though it's a percentage of your income, it's not the same as an income-driven repayment plan and how those work. Make sure you stay up to date with what's happening in the world of federal student loans and paying for college. Advisors.com has a lot of great information we're publishing on our blog. You can ask your questions on Ask the Advisor right from our site. You can also keep up with us on our socials, Facebook, Instagram, X, TikTok, and YouTube.